So I got a text message earlier today from someone that I've worked with for a while. And the individual that I've worked with for a while is working with someone else who's interested in a whole life insurance policy where cash value is the goal. Now, here's the thing. The person that he's working with is 62 years old, or in his early 60s. He's 61 or 62. But he's considering a whole life insurance policy where he is funding $2 million per year for 10 years. So $2 million per year for 10 years is how much money? That's a lot of money, isn't it? $20 million going into a life insurance policy where cash value is a priority here. So the request was really to compare an illustration. It is one product. It's specifically a 10-pay policy with one company where the health rating is exactly the same. So all he wants to see here is if I show this individual a product with the exact same life insurance company, the exact same out-of-pocket to them, everything's the same for this 62-year-old individual. If the policy is set up where the cash value is really maximized, will they have more value from start to finish? Because what he looked at initially, he said, it just doesn't look good. The original proposal that this individual had broke even by about year 10. What that means is for the first 9 years, he's paid in how much money? If it's $2 million per year, 9 years into it, 2 million times 9 years is how much? It's $18 million. At year 9, his cash value was not $18 million. It was less than that. So by year 10, he finally broke even. That was the first year that his cash value was equal to his total payments. So he's looking at the illustration and saying, this just doesn't feel right. I know something's off with this. Can it be optimized further? He also asked me about the agent commission based on the design. So I am going to go into detail on that a little bit today so you can see one product with one company, the health rating is exactly the same, the out-of-pocket is exactly the same, and what's the difference here? So let's take a look here, and here's the difference that you'll see. So policy A, let's call it this, is going to be just a pure 10-pay policy where the full $2 million is directed toward the base premium of the policy. And then policy B will be the same product, but it's going to be set up like this. $200,000 is directed toward the base premium. You'll see about it'll actually be closer to $60,000 directed toward a term insurance rider. And then everything else would be $1.74 million is directed toward our PUA rider. PUAs are how we maximize the cash value. So what we did here was set the premium at 10% of the total desired payment because that's about as low as we could drive it to maximize the cash value. The premium dollars are going to take the biggest bite out of cash value, especially up front. That's what delays our break-even point. And if you're very conservative and like to look at the guaranteed cash values, what you'll always see is that the lower the premium is, the higher the cash value is, especially on the guarantees. We're only going to look at the non-guarantees today just to keep it simple. So let's begin. Here, we've got a basic 10-pay policy. And by the way, a 10-pay policy is a great option if cash value is your goal. So if you were to look at MassMutual, for example, they've got a lot of whole life insurance products. And you're going to look at funding $2 million per year into any of their whole life insurance products for 10 years. And all products were designed equally where cash value was the priority. What you would find is that their 10-pay policy would generate the highest internal rate of return. You see the strongest cash value growth there. So a lot of times people are attracted to 10-pay products because we do see the strongest overall growth rate. Now, one of the drawbacks and reasons people are not attracted to a 10-pay product, it's kind of in the name of the product, we can pay into it for a maximum of 10 years. Some people like that. Some people say, no, I'd like the option to pay longer than 10 years. What I'll also add, you don't have to fund it for 10 years either. It's common to see some people fund it for 3 to 5 years, so it can be for a shorter period of time as well. But that's just a little bit of information on the 10-pay product in itself. So this is option A, which is the pure insurance premium product. So how we can tell is when we look up here, we see one column, $2 million, that's your annual premium. So here, $2 million per year for 10 years. Here's your cash value right out of the gates. So a 10-pay policy, how this works with most insurance companies is it functions as if it's already a blended policy. What that means when I say blended is if we take an old school whole life insurance policy, we can choose where our money goes between premium and PUA dollars. Typically premium dollars, nothing shows up in cash value in the first year. Whereas with a 10-pay policy, you will see a percentage of your premium show up in cash value right out of the gates. Here, it's a nice chunk of change when you look at it. You've got $730,000 in cash value right out of the gates of your $2 million payment. And just to put that into perspective, if that was $500K, that would be 25% of your total payment that shows up in cash value right away. It's more than that, and this is pure premium. So a 10-pay product is an attractive product in itself. So looking at this though, by year 5, you've paid in how much? $10 million. What do you have in cash value? Less than $8 million. By year 9, you've paid in how much? $2 million times 9 is $18 million. How much do you have in cash value? $17 million and change. Year 20, you've paid in $20 million. You finally have $20 million. There's your death benefit as well, appreciating over time. But this is just a pure, plain old 10-pay policy. I just write a check for $2 million every single year. It's a huge policy when you look at it. But again, this is what the individual was proposed. So it's a good thing that they asked some questions here, because here's the same product with the exact same company. And what do you see here? It's set up differently. Here's your funding, $2 million per year. Here's your premium up here. It's at 10%, $200,000. Got a term rider here. It's a little over $56,000. We've got some more term cost in there as well. Purpose of term insurance adds more life insurance to the policy at a low cost, and the total death benefit, the total amount of life insurance, is important when preventing a modified endowment contract from occurring. The death benefit has a direct relationship to our MEC limit. You can check out our video on policy design for more information on that. But bottom line, look at the difference here. Instead of $700,000 in change in the first year, you've got $1,700,000 in change in cash value in the first year. Much more cash rich right out of the gates. Your break-even point is year 5 when we look at this. So rich in equity early on, breaks even, year 5, you've paid in $10 million, you have $10.1 million with the exact same policy. Exact same policy, exact same age, exact same health rating. The difference is we just set it up differently where we reduce the premium and maximize the cash value. Let's look at a side-by-side here. So on the left, you've got the standard setup, and on the right, you've got the blended policy. So we can add a cash value difference column here, but we really don't need it. Look at year 10. Cash value is $20 million and change. How about this on the far right? $23 million in change. That's $3 million more in cash value. Now the death benefit is growing at a much faster pace. You'll typically see that when you're adding funds to your PUA rider. We did drop it here in order to reduce term insurance, but it doesn't make much of a difference. I mean, the death benefits are close when we look at it long term, but still, you'll see the clear winner from start to finish is who? The blended option, $37 million in cash value, compared to over here, by year 20, $33 million in cash value. That's a huge difference. You're close to $4 million. We can scroll down to, as far as we'd like. Let's look at year 30. the difference is about $5 million, a little bit less. So just by designing the policy differently, we see significantly more money in cash value from start to finish. So again, same company, same product, same individual, same out-of-pocket to them. If this is you funding a policy with $2 million per year, like the out-of-pocket to you is the same, and you're paying the same dollar amount to the insurance company every single year. A question I get a lot is, why doesn't everyone do this? The reason why is because they're often not even made aware of it. Really, when you look at it, usually when you look at life insurance sales, we're shown one option and that's it. I thought it was a good idea. Like that's what I was told. It looked like the best option. So let's look at a comparison here. We've got the standard setup to the left. Here's the annual commission with a 10-pay product. So $2 million per year going in. 10-pay products typically do have a much lower commission rate compared to traditional life insurance policies, but it's still high. The total commission comes out to almost 50% of the total payment in the first year. It's almost $1 million in first year commission. Then we've got the running total, which will just tally up each year's commission. Okay, that's high there. Now let's compare that to the blended policy. And we just used our compensation rates to calculate the actual percentages here. So what do you notice? If you look at the total amount you make with the option to the right, $600,000 over 10 years, that's about two-thirds of what you would make just in the first year alone with the all premium product. So all that means is when you do blend a policy for maximum cash value, it's going to impact two things. One is the upfront cash value. Two is the compensation paid to the agency or agent that you are working with. And that was asked about, which is the main reason we decided to talk about it in this video. So with that said, I do hope that this video helped. I hope you enjoyed it. If you have any questions, please let us know, and we'll see you in the next video. Thanks so much. Hey guys, Steve here with IBC Global. Thank you so much for watching the video. If you're interested in a whole life insurance policy and you'd like to work with our company in setting it up, please visit our website, ibcglobalinc.com. We would love to work with you. If you have any questions, please leave them in the comments below. And as always, I hope this helps.